Option 1, definitely more on the risky side, is a royalty trust. A royalty trust works like this. You own land, and under that land is oil. But you don't drill it, you don't touch the oil, you instead have somebody else do that. And every time this other company pulls that oil out, they pay you a little bit of money every time oil comes out. A royalty trust is the company that's collecting money from the oil and gas company, pulling the gas out from this land that's not theirs, and then they have to pay out most of their profits to the shareholders, people like you. The reason why is because royalty trusts are generally required by law to distribute 90% of their profits to their shareholders. The reason why I say this is more risky is because they don't actually run a business. They're not working to grow. They're just gonna keep paying until they go dry. Literally, when the oil is gone, they stop making money. A couple of the larger royalty trusts, and no, I'm not recommending these. Again, investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Or PBT and SBR. These are stock ticker symbols. So if you use any stock brokerage out there, there are so many. You can find one that you like. Just Google stock brokerages, see one that you like. These are two of the larger ones. And the reason why some investors like these is because you can see higher dividends generally. They're paying out generally in the range of 5 to 10% a year in dividends, which means if you invest $1,000, you would be making $50 to $100 a year in cash flow as long as they're actually making money. The cons here are number 1, you have volatility in the stock price and the amount of dividends that you get. Because, well, when oil prices are going up and down, the interest in these royalty trusts also go up and down. And so when the stock price changes, the dividend yield that you're getting also changes. Not to mention that when oil prices change, the amount of profits that these companies are going to be getting are also going to be changing. Just to give you an idea of what I mean, if a company is trading for $100 a share and they're paying out a $1 a year dividend, that's a 1% return a year. But if the stock price fell to $50 and they're still paying a $1 dividend, well, the dividend didn't change, it's just now a 2% dividend because the stock price has changed. The second risk is that it's a depleting asset because once the oil is gone, the company's gone. And risk number 3 is that these are generally smaller and thinly traded and can be impacted by the economy. If oil prices jump up to $100 a barrel, well, they'll start making bigger profits. If oil prices fall, these companies will get hurt. So will your dividends. So here we have something high risk paying out 5 to 10% a year. On the complete opposite end is a lower risk investment like a treasury. A treasury is when you lend money to the United States government. We all know that the United States government has a lot of national debt and they can borrow their money from people like you and me. And when you lend money to the United States government, you are the bank lending money to the United States government, and in exchange for you giving your money to the government, they will pay you with regular interest payments. Now, you can lend your money directly to the government by going to something like Treasury Direct, or you can do it on the stock market by investing in an ETF that gives you exposure to these treasuries. A couple examples of this would be SGOV and SHV. SGOV is a fund that gives you exposure to short-term treasuries, generally 3 months or less. And SHV is very similar. It also gives you exposure to short-term treasuries. This time they're generally 1 year or less. And both of these ETFs are paying around 4.5% a year in dividends. Now, the interesting thing about this is that these are backed by the United States government, because when you're lending money to the United States government, well, you're protected because if the United States government goes bankrupt, the whole world would feel the pain. And this is where you have a little bit of protection, where you'll see that the stock price generally does not move. The only time the stock price moves is when it pays out its monthly dividend, and then the stock price will drop by the amount of the dividend. So you're really not seeing a variation in the stock price, you're just generating interest, and this is a way for you to generate the interest by doing it through the stock market. Now, yes, this is not FDIC insured because you're not putting your money into a bank, you are investing your money. However, you are protected because, well, you are backed by the United States government, and if the United States government collapses, you're not going to get your money back. But there's going to be a lot of other problems that play here too. And the other nice little benefit here with these treasuries is that because it is lending money to the United States government, you're generally exempt, meaning you don't have to pay state and local taxes on the income that you get from these. So these are paying out around the 4.5%. And the one last con here is that you're not actually going to see any growth in the value of your investment. You're only investing in this for interest because, well, it's a loan. And the third and probably the most traditional way to do this, which we'll call for this example, something of middle risk, would be to invest your money into into stocks that are paying out dividends. Now, I want to remind you that if you are an investor or want to become an investor, my team at Briefs Media publishes a free daily report called Market Briefs, where we're breaking down what's happening in the stock market, housing, crypto, global markets, and our own economy into a fun, witty, and easy-to-read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and when you join Market Briefs, you'll also get an investing masterclass as a bonus for free, where I break down how you can get started as an investor and find hidden investment opportunities before anybody else. So if you want to get Market Briefs plus my investing masterclass all for free, all you have to do is click the link down in the description below. There are companies like McDonald's that are making billions of dollars a year in profits. And when they have this big profit, they can do three things. They can save this money for an emergency, they can reinvest this money back into the business, or they can take this money and give it away to shareholders, people like you. And this is where a dividend is one way that companies can give it away to shareholders. And generally, these dividends are paid out quarterly, meaning every 3 months. Now, the difficult part here is to find the right company, because yes, McDonald's pays a dividend. And if you keep investing your money into McDonald's, that might be great this year, next year, the year after that, but in 10 years, it might go bankrupt. Who knows? And if they do go bankrupt, well, that means not only do you lose all of your cash flow, but you lose your entire investment as well. And this is where, if you don't want to keep up with all of your stocks, the alternative is to invest your money into a fund that specializes in dividends. A couple examples here are SCHD and NOBL, and as a disclaimer, I'm personally invested in SCHD. SCHD is an ETF, meaning a fund created by Schwab, and this gives you exposure to a broad basket of United States companies that specialize in dividends. So this is investing in hundreds of dividend-paying stocks, and instead of going out and investing in those stocks yourself, you can invest in this fund and get exposure to those dividend-paying stocks. If one company, say McDonald's, goes bankrupt, well, the fund would kick it out and replace it with a different company. NOBL is a little bit different. Noble is an ETF that gives you exposure to dividend-paying aristocrats in the S&P 500. What does that mean? It's dividend-paying companies in the S&P 500. Meaning these are some of the 500 largest companies in the stock market. If it's not one of the 500 largest, it's not going to be in the S&P 500. So it's in the S&P 500, it pays a dividend, and it's a dividend aristocrat, meaning it has paid out and increases dividend every year for at least the last 25 years. So these are more historical longevity dividend paying companies. At the time of recording this video, Noble is paying around 2% a year. SCHD is paying around 4% a year. So if you invest $1,000, you're gonna get $40 out of here, $20 out of here in year one. Now the real pro here is you're not taking on a whole lot of risk, but you have a lot of potential upside. What do I mean by that? Number one, in addition to your dividends, you can also see the value of your stocks go up, because the idea is to own good investments. And if you own good investments that are making bigger profits, in theory, they will also become more value, which will make the value of your investments also more valuable. Number two, if these companies are also making bigger profits, in theory, they should also be paying out bigger dividends. So hopefully the goal would be to not only get the dividends today, but next year get bigger dividends, the year after that bigger dividends, and on and on and on, because you are investing in the profits of these great companies. Now the risk is, of course, you're investing in stocks. If the stock market crashes, you can see the value of your portfolio go down, and the value of your dividends go down as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.